Now let's continue with the uses. So the 5 and 13 crossover on the 15 minutes time frame is a signal. The signal for an entry is an entry confirmation. Call it an entry confirmation. So our second leg M should close below the 5 and 13 EMA, and we should have the 5 and 13 cross. So you should wait for the price to do that. Our second leg W should close above the 5 and 13, and there should be the 5 and 13 cross for you to enter. So the 50 and the 200 EMAs, we have the EMA bounce trades. We'll talk about it when we talk of the trades. Also the 800, you have the blueberry trade if you miss the peak. The 50 and 200 cross is a trend confirmation that a peak is locked. This is in the 15 minutes time frame. In the hour one is the 13 and 50 crossover. Okay.
Okay. Yes.
As we go on, we will see other uses of the EMA. So we have the blue tracer. The blue tracer marks yesterday's high or yesterday's low. Market makers do what is called to be the high road reel on the yesterday's high and yesterday's low. So on yesterday's high and yesterday's low, we expect the high test pattern or the low test pattern. That's the first thing for you to enter. And suppose the dealer does this. This is a stop and flow. Breaks the blue tracer here. After breaking the blue tracer, it comes back aggressively.
Okay.
There is your entry. 513 cross above 5 and 13. There is your entry. And if you take that entry, you wait for another 2 hours. If you find yourself that you are not in deep profits, like this one, you find the dealer is simply consolidating around this area. So you should know that the dealer's intention now is not to go long, is to extend the stop at. Okay. So you should scratch out that trade. Those are the rules. And an example, a good example is this one. You see this. And this, the high road drill usually happens on when the dealer fakes the M's and W to go towards the peak. We know that the peak is low. Yeah. We know that the peak was around. We know that the peak is low here. So the dealer forms a peak low. He moves the first level, the first day. On the second day, he does the stop and low. He comes to the stop and high here. I mean, he does the stop and low here. After that, goes to the yesterday's high, like what he did here, and he fakes the M here. So if he fakes the M, that means if you trade this, you trade towards the peak, but we usually take trades away from the peak.
Okay.
So if you take a trade around this area, you'll find the dealer doing this, the high road drill. So this is a fake M, a fake setup for people to go short, and then the dealer would go long, as you can see here. And there is another one here, the high road drill. You see it. Here the dealer comes for the first time. He does the high test again, comes again. So this one is basically the high road drill. So you should know that where your peak is. You should know which level you are for you to take the setups on yesterday's high or yesterday's low. We have the color-coded sessions. Those are the boxes that shows the session. The blue box, the Asian, the light blue, the gap time, the red Crimson, the New York session. And you have the stop and boxes. So the TDI, now let's talk of the Traders Dynamic Index, TDI. We use the TDI on our 4 time frame only. Okay?
I lost the audio.
Lost audio.
There, it's coming back. There, now we're good.
Okay. Did we talk of the color-coded section?
Yes, I heard that.
Okay. Now the TDI, the Traders Dynamic Index. We use the TDI on our 4 time frame only. Okay.
I lost the volume
Lost audio again. Let's go with the network today. Can you hear me now?
Now I can, yes.
Okay, now the TDI, the Traders Dynamic Index, we use it on the hour 4 time frame only. At any other time frame, we don't use the TDI, okay?
Okay.
Now let's look on the parts of the TDI. We have the volatility bands, the blue bands here, called the volatility bands, okay? Now the volatility bands come with the market baseline. You see this yellow line here. This is called the market baseline. This one is a linear weighted moving average with a period of 50. So on you see the TDI here. We have the extreme high, the level extreme high, the 80, the level high, the 70, the level low, it has the 30 level, and the level extreme low is a 20 level, and we have the middle level, the 50. Now the middle level here, it's stagnant, but we have a moving 50. The market baseline here, it acts as a moving 50.
Okay.
So another line is the red line here, is the signal line.
Okay.
It's the RSI signal, it's the signal line. It's called the signal line, and we have the RSI price line, the black one, which is the important line. The black one and the volatility bands. We usually use them.
Okay.
Okay, now we know the parts. Let's look on the uses. Now, when price reaches on the extreme highs, like when it reaches on this high or on the extreme high, we call it the bullish divergence. If the price is in bullish divergence, we expect a reversal there. So when price reaches, when the RSI price line, not the RSI price line, this one, the black line.
Okay.
When the black line reaches at this level, the extreme highs, we call it a bullish divergence. There we expect a reversal to the low. And when it reaches the extreme low, we call it the bearish divergence. Okay?
Okay.
Now, when it reaches the extreme highs or the extreme lows, And the RSI price line, it's below the volatility bands. You see, it came out of the volatility band and then it came back in. Okay.
Yes.
And here also it came out of the volatility band and then it came back in.
Yes.
We call it a shark fin. Like it's like a fin of a shark. Sometimes it happens like a fin of a shark, exactly. So that one we call it a shark fin. Now, how do we use the bullish divergence and the bearish divergence and the shark fin? On peak formation, when the dealer forms a peak, like here the dealer was forming a peak high, here the dealer was forming a peak low, here there was a peak reset, here there was a peak. So when the dealer is forming the peak, usually there is a shark fin. The RSI price line is usually outside the volatility band, it comes in. You see this is a peak reset. The peak reset, usually the shark fin is around the 50, you see around the 50 here.
Okay.
And this one is also a peak, and this one was a peak. So a good peak is formed when the shark fin appears on the extreme highs or extreme lows. When there is a bullish divergence and at the same time there's a shark fin. This one was a good peak. This one was a good reversal. This is also a peak. We have a good peak on pound USD. Pound USD last week, a peak low. Yeah, the peak low pound USD last week. It had a very good shark fin and it was an area of a divergence. Dana called that. He called that it. Don't know if he took a trade, but he talked about it on the group. So another use of the hour 4 TDI apart from the shark fin. So basically the shark fin is the main thing that we are looking for during the peak formation on the hour 4 time frame. Okay.
Okay.
So we'll talk of the peak formation later. But when I talk of the shark fin later, you will understand. Okay.
Okay.
So another thing the hour 4 shark fin can do is level count. As you can see here, the peak was formed. We have level 1, we have level 2, and you have level 3. And then here we have level 1, level 2, and there's a level 3 here, but it's not sharp enough. And then there was a peak here. You see level 1, a consolidation, level 2. Here there's a bit, level 3. There's level 1, level 2, level 3. And if the levels are completed, there's a peak extension, find this one. There's some peak extension there.
Okay.
I think you get me there.
Yes.
So this one was a very beautiful one on Euro USD. You see the levels here, 1, 2, 3, very beautiful. So you can see it on the TDI on the hour 4 time frame. Okay.
Okay.
So you see a peak extension. Also, you can see a peak extension here after the 3 levels. You find that the TDI is going on trading low. That's a peak extension. Okay, now let's shift to the cyclic levels. The cyclic level, the other form is the psychological support and resistance. So we have it as the black lines. I usually don't use it because I found that it has very little significance. Very little significance on the charts. So let's insert it here. Cyclic level. Chart indicators, custom indicator, there. So these are the cyclic levels. These are used on the weekly cycle to identify the weekly cycle that the dealer would break high or low first. So you can see here the dealer break the high and then he trades low. You see here there's a very little significance on the cyclic level. You see it.
Yes.
So the weekly cycle here does not coincide with the market maker cycle. That's why you see the weekly cycle. You see the weekly cycle is not clear. But at some point you'll find that the market maker cycle and the weekly cycle have coincided. So this cyclic level, we use it on the hour 4 time frame. As you can see here, this was a good example on Euro USD. There was the cyclic level, and dealer did break the high. See, this cyclic level usually shows the Asian range of Monday. It usually plots the Asian range of Monday. So the dealer broke high, and then he came back for a retest. So the breakout traders here were convinced that this is an uptrend, and then the dealer reversed from here to the 3 levels. So the dealer formed a peak high here, and this is our 4 time frame. The period separator here shows the weekly. So this one is the whole week. So you can see here there was a sharp fin on the hour 4, and the dealer already showed his hand on the stop hunt here. The false move. So this was a very beautiful peak to take. And when we talk about the harmonics and the types of peaks, you understand that this was a very beautiful peak.